Picture this. It's midnight, and you're scrolling through your phone, watching another market expert confidently predict which sectors will crash in 2026. Meanwhile, in a quiet corner office in Manhattan, a portfolio manager is moving $2 billion out of last year's winners and into 5 companies that most people have never heard of. He's not panicking. He's not following headlines. He's following something much more powerful: the invisible currents that move trillion-dollar waves of capital around the globe. What if I told you that some of the most interesting market opportunities of 2026 might be hiding in plain sight, disguised as boring, stable companies that everyone assumes are too safe to generate meaningful returns? What if the very stocks that seem bulletproof are actually the ones positioning themselves to capture massive capital flows that are about to shift directions? If you want to understand where money is really flowing, make sure to subscribe to this channel. Because what I'm about to show you isn't just stock analysis. It's understanding how money behaves when fear meets opportunity, when cycles turn, and when smart money makes its move while everyone else is still debating what happened yesterday. Stay with me for the next 12 minutes, because I'm going to walk you through 5 companies that aren't just weathering the coming sector rotation, they're potentially positioned to thrive in it. In a moment, I'll show you the bigger picture that most investors can't see. Let me paint you a picture of what's really happening in global markets right now. Imagine money as an ocean. For the past 2 years, that ocean has been flowing in one direction, into growth tech, into AI hype, into anything that promises exponential returns. But oceans don't flow in one direction forever. They turn, they shift, and when they do, fortunes are made and lost based on who saw the tide change coming. Right now, we're witnessing something fascinating. Interest rates are stabilizing after one of the most aggressive hiking cycles in modern history. Inflation is cooling, but not disappearing. Geopolitical tensions are reshaping supply chains. Demographics are shifting demand patterns. And here's the key insight most investors miss. When multiple forces converge like this, money doesn't just move randomly. It follows predictable patterns. Think of sector rotation like musical chairs, but with trillion-dollar consequences. When the music stops, some sectors get left standing, while others suddenly find themselves with all the capital. The question isn't whether rotation will happen. It's already happening. The question is, can you identify which companies are positioning themselves on the right side of it? If you were managing money right now, where would you look for stability? In the companies everyone's talking about, or in the ones quietly building fortress-like businesses while everyone's looking elsewhere? Here's why this moment in early 2026 is absolutely critical. We're standing at the intersection of 3 massive trends. First, the post-pandemic economic rebalancing is finally complete. Second, the initial AI investment boom is maturing into actual profitable applications. Third, and this is huge, we're seeing the early stages of what I call defensive growth investing. Defensive growth sounds like an oxymoron, but it's not. It's the recognition that in an uncertain world, some of the most valuable companies might be those that can grow steadily while protecting downside risk. These aren't the flashiest stocks. They're not going to triple overnight, but they possess something far more valuable: predictable cash flows in unpredictable times. Stay until the end of this video, because I've saved the most compelling case for last. Because the 5th company I'm going to discuss has a competitive advantage so strong that it's essentially impossible to replicate, yet it's trading at a valuation that seems disconnected from its market position. In markets, winners aren't always the fastest movers. They're often the ones positioned on the right side of long-term trends. And being on the right side means understanding that 2026 isn't necessarily about finding the next Tesla. It might be about identifying companies that will be generating consistent cash flow when Tesla's growth story eventually matures. Let me introduce you to our first case study, NextEra Energy. While everyone's debating whether renewable energy is overvalued, NextEra has been quietly building the largest renewable energy infrastructure in North America. But here's what makes them different. They're not just generating clean electricity, they're building the backbone that will support America's energy transition for the next 3 decades. Their story is beautifully simple. Every data center, every electric vehicle, every heat pump that replaces a gas furnace increases electricity demand. NextEra owns infrastructure that delivers that electricity. But they've done something brilliant. They've built their renewable capacity at costs so low that they can sell electricity cheaper than fossil fuel alternatives, while maintaining industry-leading profit margins. Last quarter, they generated $1.8 billion in free cash flow. Their dividend has grown for 29 consecutive years. They have a $95 billion backlog of renewable projects already contracted. This company might not be overvalued today. The market might be misreading its tomorrow. While everyone's worried about renewable energy subsidies, NextEra has achieved grid parity. They don't need subsidies anymore. The opportunity cost here is real. If this trend accelerates, many investors might find themselves watching from the sidelines as the U.S. electricity infrastructure gets rebuilt over the next decade. Our second case study lives in a completely different world. Vertex Pharmaceuticals. In healthcare, most biotech companies are gambling on single drug candidates. Vertex has already won the lottery, not once but multiple times. They've created a monopoly in treating cystic fibrosis, a rare genetic disorder affecting 75,000 people globally. But here's the brilliant part. They're not stopping there. They're using their cash flows from CF treatments to fund research into other genetic diseases. Sickle cell disease, diabetes, pain management, each representing massive addressable markets. Their CF franchise generates over $9 billion annually with 85% gross margins. That's pharmaceutical royalty-level profitability funding the next generation of breakthrough therapies. The risk, competition, and patent expiration. The potential upside. They're essentially printing money to fund multiple shots at creating the next generation of genetic medicines. In a sector rotation toward quality healthcare companies, Vertex sits at the intersection of growth and defensive characteristics. Number 3 takes us into a sector most people find boring: waste management through Republic Services. But boring businesses often make the most interesting case studies. Every day, every household, every business generates waste. Economic expansion increases waste. Recessions, people still throw things away. This business model appears recession-proof and inflation-resistant. Republic has been consolidating the fragmented waste industry for decades. They've built route density in major metropolitan areas that creates incredible competitive advantages. It cost them $50 to collect your trash. It would cost a competitor $150 to replicate their route structure. That's an economic moat disguised as garbage trucks. They generate $1.4 billion in annual free cash flow, growing at 8 to 10% per year. Their return on invested capital exceeds 12%. As environmental regulations tighten, waste management becomes more complex, favoring large, sophisticated operators. Republic is positioning itself as the infrastructure play on America's growing waste stream. Our fourth case study represents something fascinating: the intersection of old industry and new technology. Caterpillar builds the machines that build the world, but they've quietly transformed from a cyclical manufacturer into a technology-enabled services company. Here's their secret weapon. They don't just sell bulldozers anymore. They sell uptime. Through IoT sensors and predictive analytics, they monitor their equipment remotely, predicting maintenance needs before breakdowns occur. Their services division now generates 20% of total revenue with significantly higher margins than equipment sales. Global infrastructure spending is accelerating. Deglobalization requires domestic manufacturing capacity. The energy transition needs massive amounts of copper, lithium, and rare earth mining. Every data center requires construction equipment. Caterpillar sits at the center of multiple secular growth trends while maintaining pricing power through their installed base of equipment. The fundamental story is compelling. As reshoring accelerates and infrastructure investments multiply, Caterpillar becomes essential infrastructure for building essential infrastructure. Now let me introduce you to our fifth and most contrarian case study: McDonald's. Yes, the hamburger company. But that's exactly the kind of conventional thinking that sometimes creates opportunities. McDonald's isn't really a restaurant company anymore. They're a real estate and franchising empire disguised as a fast food chain. They own some of the most valuable commercial real estate in the world: corner lots in major cities, highway intersections, suburban centers. They lease this real estate to franchisees at rates tied to sales performance. As their locations appreciate in value and sales grow, their rental income compounds automatically. Here's the defensive brilliance. During recessions, people trade down from expensive restaurants to affordable options. McDonald's benefits. During expansions, higher wages and consumer spending boost same-store sales. McDonald's benefits. During inflation, they raise prices faster than costs increase. Their franchisees absorb most operational risks while McDonald's captures the upside through percentage rent and supply chain markup. They return over $6 billion annually to shareholders through dividends and buybacks. Their return on invested capital exceeds 20%. They're expanding globally into emerging markets where rising middle classes are just discovering branded fast food. This isn't just growth, it's compounding at scale. But let me show you where most investors go wrong. Because understanding these potential traps is just as important as identifying opportunities. The biggest risk in 2026 might not be market crashes or economic recession. It could be chasing performance in overhyped sectors. Artificial intelligence infrastructure stocks are trading at valuations that require perfect execution for decades. Electric vehicle companies are burning cash while competing in an increasingly saturated market. Cryptocurrency-related businesses remain speculative bets on regulatory outcomes and adoption curves that may never materialize. When everyone's running toward the same opportunity, that's often where you find traps instead of profits. The companies everyone's talking about may have already captured most of their potential upside in their current valuations. Meanwhile, companies solving boring problems with predictable cash flows are trading at reasonable multiples. The second trap is timing. Just because a company is fundamentally sound doesn't mean its stock will perform immediately. Markets can stay irrational longer than investors can stay solvent. That's why position sizing and patience matter more than being right about individual companies. So how might you think about building a portfolio around these insights? This analysis isn't suggesting you put all your money into 5 stocks. It's about understanding how different types of businesses complement each other during different market conditions. A theoretical balanced approach might allocate 15 to 20% to infrastructure plays like NextEra, providing steady dividend growth and inflation protection. Another 10 to 15% to healthcare innovation through companies like Vertex, capturing demographic trends and medical advancement. Essential services like Republic Services might deserve consideration for recession resistance and steady compounding. Industrial leaders like Caterpillar could represent exposure to global infrastructure and manufacturing trends. Consumer franchises like McDonald's might warrant analysis for their combination of defensive characteristics and emerging market growth potential. How much would you personally allocate to each category? The answer depends on your risk tolerance, time horizon, and conviction levels. But the framework remains consistent. Diversify across sectors, prioritize predictable cash flows, and focus on businesses with competitive advantages that strengthen over time. The beautiful thing about this analytical approach is that it's designed to work across different economic scenarios. If growth accelerates, industrial and infrastructure companies could benefit. If growth slows, defensive characteristics of utilities and consumer staples might provide stability. If inflation resurges, companies with pricing power and hard assets could outperform. As we wrap up this analysis, remember that successful investing isn't about predicting the future perfectly. It's about positioning yourself to benefit from multiple possible outcomes while protecting against scenarios that could permanently impair your capital. These 5 companies represent different approaches to the same goal: building businesses that can adapt and thrive, regardless of what 2026 brings. They're not guaranteed winners. No investment ever is. But they possess characteristics that have historically created wealth during periods of economic and market uncertainty. Here at StockAura, we don't follow the news. We analyze the system. We look at cash flows, competitive positions, and market dynamics rather than daily price movements and media narratives. That's how you build sustainable wealth rather than just capturing temporary gains. If this analysis has helped clarify your thinking about sector rotation and quality companies, I need you to do 3 things. First, hit that like button so this reaches other investors who are tired of hype and speculation. Second, subscribe to StockAura and turn on notifications so you never miss our deep dives into market opportunities and potential pitfalls. Third, and this is crucial, tell me in the comments which of these 5 companies you find most compelling for analysis and why. Your engagement helps us understand what type of content creates the most value for serious investors. And if you have other companies you'd like us to analyze using this framework, drop those suggestions in the comments as well.
Follow the money, not the crowd. While everyone else is chasing headlines and hoping for quick riches, focus on understanding businesses that compound wealth steadily over time. That's how real fortunes are built, not overnight but over years and decades of intelligent analysis. I'll see you in the next video, where we'll dive deep into the accounting red flags that can help you avoid value traps disguised as bargain opportunities. Until then, stay focused on what matters: cash flows, competitive advantages, and the long-term trajectory of the businesses you're studying.